Manar, welcome back.
Thanks, Rob. Thanks for having me again. We took a little break there. I think it's good for the folk listening.
I know. It feels like we've been on a regular cadence of getting together. And on this occasion, here's where I want to start. I want to imagine that I'm a Mawer client, which isn't very difficult, by the way, because I am a client of the global equity strategy. Opening my June statement and seeing that, hey, my return over the past year is up double digits. So I feel pretty happy. But then I look at the benchmark and realize that it is up considerably more. And so can we start there? Why is it that we are lagging our benchmarks in this type of environment?
Yeah, no, I think that's important. We think about that a lot. And so, first point, obviously, is the concentration in the indexes have gotten a bit crazy. So we're underweight the Magnificent Seven. I hate to support the acronym, but we're underweight that Magnificent Seven by 10%, and roughly the same for semiconductor companies and the like. Another reason is, some boring is out of favor versus kind of, if you think of artificial intelligence. So think of consumer staples and healthcare, kind of a little bit out of favor in terms of the boring industries. And how we've historically created value, Rob, is over the long term is our downside captures, outperforms. And so, I think over the last 10 years, something like 85%, we only capture 85% of the downside. Versus our upside capture typically lags or just barely keeps up. And the math is intuitive about how that creates value for clients over a long period of time. So just to exaggerate the point, if you're down 50%, you need to be up 100% to recover. But if you're down 40%, then you only need to be up 67%. So over a long period of time, that kind of tends to compound wealth. And honestly, Robbie, just to inject humility here, we probably have some errors in our portfolio that we haven't yet realized, but we're not resting on our laurels here. We're trying to uncover those errors as quickly as possible. But likewise, I think in the same breath, we likely have some winners in there that are unrealized today.
Got it. So, I think clients know that typically in exuberant markets, a be boring style doesn't tend to keep up as much. But I want to continue on something that you just mentioned, which is the call them the potential errors of commission. So less about stuff that we don't own, but more about what's in the global equity portfolio. And I'm wondering if there are a couple of stocks that you can touch on that perhaps haven't done as well over the past year. Maybe they've been flat or down slightly, and just what our updated thinking is on those securities.
Yeah, absolutely. And maybe I'll do a quick aside on errors of a commission, because I think it's important about our perspective on that. So we think of it as a kind of a balancing act between learning and improvement, and then being careful to learn the wrong things when we're assessing our errors of commission. Annie Duke calls this resulting, which is this idea is you look at the result and you try to learn from that only. But really, we think of it as kind of a matrix of good, bad decision and good, bad outcome. So sometimes you can make good decisions and have bad outcomes. And when we're looking in the short term, there's a lot of statistical kind of noise, and that becomes more apparent over a long period of time. Our average hold period is something like 8 to 10 years. So that, we try to look at the track record over that period of time. And in our view, it's quite a kind of weak form of error if you can't relate it back to what you would change in your process. And so I'm reminded of Deming's kind of funnel problem, right? So he drops a marble through a funnel onto a sheet of paper, and that has a target. And the goal is to get the marble to stop as close to the target as possible. And he basically tells the subjects of the experiment, like, hey, the goal is adjust the funnel so that the marbles fall more precisely onto the target. And so statistically, the optimal thing to do is to drop a lot of marbles, first get a sufficient sample size through the funnel, and without making any adjustments, and then find the average position where they fall. And that's the amount of kind of adjustment you need to just adjust the funnel. But the human behavior is we adjust the funnel immediately. We drop only one marble and we quickly adjust. And that rule, of, hey, adjust the funnel after each marble produces actually the greatest variability. So what happens is your process becomes unstable. So you have these knee-jerk reactions.
I can get a sense for, you got to keep the eye in the long term. You want to weigh information in the short term a little bit more lightly. But I guess more specifically, and I'm thinking of a position like XP, which was probably one of the portfolio's top performers last year, and yet one of the bottom drivers so far this year. And so what's going on there?
So XP is just as a quick refresher, is the number one independent broker dealer in Brazil. They have roughly 80% of the independent financial advisors in Brazil. And we for risk management purposes have a smaller position size in XP, kind of due to emerging market risks. It's in Brazil. Obviously, there's a capital market cycle as where equities flow and have outflows. But what's happening there is really today the Brazilian central bank rate is something like 10.5%. And so if that's your opportunity cost, if you think about, do I invest it in equities, for example, or do I invest in a daily liquid instrument, then that's a pretty high bar, right? I can earn 10.5%. Now, the key in our mind is, well, one is XP is still seeing net inflows. They've slowed, but they're still seeing net positive inflows into their platform. And the second thing is they're plugging other products into their distribution network. When you have, something like 14,000 independent financial advisors, you start having this network effect where you can, like insurance products, like credit cards, they're plugging into their network, tapping into higher net worth clients within Brazil. And, if we step back, the reason to own this is, while it has a small market share of a large and growing market, if we think of the oligopoly in Brazil, the top 5 banks still have 80% of the assets under custody within Brazil. So, tapping into that, disrupting that type of market, they have identifiable competitive advantages. I mean, when we think about the business, it has really high switching costs. Like if you have your assets on their platform, you have the expense and the tax impact of trying to move your account, the trust and the credibility that you build with your financial provider, and of course the distribution moat that they have and the breadth that they have it. And then they have engaged owners who understand the value drivers of the business, have roughly 20% economic interest within the business across a group of management members. And they're returning excess capital today. And, we think of it as having positive convexity to rate cuts, as Brazil kind of slowly goes down that path. And all of that, you get a pretty modest valuation, Rob. I mean, I think the multiples, on dumb numbers, kind of under the emerging market index. So something like 12 times versus 14 times with double the ROEs, returns on equity. So yeah, also say, I mean, we have a longer term horizon with this, but we still manage our risks through position sizing, right? So, kind of under 2% weight.
And specifically, like you said, just given some of the country risks, I know the currency is down pretty considerably relative to the US dollar so far this year too.
Yeah.
What about another position like Robert Half, which I think we added to the portfolio around this time last year?
Yeah, Robert Half. So maybe a quick refresher. It's a temporary and permanent staffing agency, and it has also kind of a mini Big Four, accountant consulting business. So the KPMGs and the Deloitte of the world, they have a mini Big Four consulting business, which is sizable today, roughly 30% of operating profit. We incremented into this from a position size perspective due to the cyclicality. I mean, if you think of staffing cycles, it can be pretty brutal. But one thing is typically temporary staffing is a leading indicator of employment cycles. So
Okay.
you can think of it as FIFO, first in, first out. And so companies tend to cut temporary labor early,
Mm-hmm.
and then when there is a kind of a positive cycle, they come in first. So you can think of it as
Right.
kind of a
Got
leading
it.
indicator. But when we look at the business, obviously we think it has great fundamental features. The business is asset light. I mean, it's a people business. So, it doesn't require a lot of capital to grow. And as such, it has really high returns on capital through cycles. We have excellent alignment with the CEO and management team. And despite kind of earnings being more cyclical, the free cash flow of the business is quite stable relatively to the earnings profile, because in a downturn, the accounts receivable turn into cash. And so the free cash flow profile is more stable. And the owners of the business, the management team of the business, understands that it's quite a brutal cycle, and so they have net cash on their balance sheet, worth 6% of their market capitalization.
Okay, so it sounds like we were pretty eyes open going into this investment last year, recognizing the cyclicality. Robert Half sort of took a half position maybe at the start, a smaller
Call it a
position to
quarter.
start.
Call it a quarter.
Yeah,
Half a half.
and have been adding just as the stock has gotten weaker, given the great long-term prospects of the business.
Yeah, and I think if you have a longer term horizon, you look through mid cycle, through cycle. We think that there's a modest valuation. It's kind of the old lumpy 15% versus a smooth 7%, type of return profile. But we think that there might be some underappreciation of two things that they've done, which is they've improved their mix to higher skill. So think more CFO, senior accountant types versus kind of more ground level accounting. And their many big four consulting businesses now 30% of their profit. So it's a more robust, less cyclical part of the business.
Got it. Can you talk about AI with respect to Robert Half?
Yeah, I mean, I think there might be some concerns lingering around, the staffing business in particular. Like, hey, this generative AI is going to replace all the accountants, I think that we think about it in a few ways. Obviously, the bands of this, there's some uncertainty, but Robert Half has significant scale advantages. I mean, particularly in their data, more than 30 million candidate database. And this is not resumes. This is, proprietary data that they have because they're the employer of record. So that means they have your on-job performance data that you wouldn't otherwise be able to get. And we think that proprietary data is likely the scarce input into the models, these large language models that may commoditize over time. So everyone's going to have these models. The question is, how valuable is that data that's going in? And so that proprietary data is critical. Another thing, Rob, is you don't really want your accountant to hallucinate. Although we do see some financial statements from some time to time, looks like where we think the accountant might be hallucinating, but that's one aspect, and that's why we do our own forensic accounting as a sidebar. But the third piece I would say is looking at historically speaking, there's been no net reduction in the number of jobs in accounting. And that's amazing because
so you're talking going back decades as we've introduced QuickBooks and other products that help accountants. The level of staffing has stayed pretty consistent.
Yes, and of course there's been shifts underneath. Like if you can use QuickBooks and you can't use QuickBooks, you might have lost a job. You need upskilling or uptraining. Mm-hmm. But if I think of those shifts, like even just manual to spreadsheets to software type of shifts, these are massive cumulative shifts. Generative AI today is not as big of a shift. I mean, a lot of companies have already automated a lot of parts of their accounting, but yet there's been no net reduction in the number of jobs in accounting. And so in context of the magnitude of the shifts in the past, it's much smaller, I would say, relative to that today. And of course, Robert Half, is not sleeping on the wheel. They two parts of their AI program. I mean, they have AI recommended clients, so better recruiter productivity. So, I mean, think about LinkedIn coming in, and it hasn't really disrupted their business. What's happened is it's augmented the recruiter's productivity, right? They use that as a database. And then better candidates. So they're getting to AI recommended talent, but obviously there's all sorts of pitholes you got to be careful of when you're recommending talent that's mission critical to these small businesses.
Okay. Shifting to errors of omission, maybe, but very much on the topic of AI. And zooming out, I suppose, and just thinking, I heard in a recent risk management meeting, somebody say that there are kind of two risks right now. One is that we're in this giant AI bubble, and the other risk is that we're not. That this is, legitimate, sustainable, and NVIDIA being the most important stock in the world, really, at the moment. Mm-hmm. Where do you fall on this? Where does the global equity team fall? Do you have a view? Presumably, just given the way the portfolio is postured, there's a lean potentially a little bit one way, but I'm just curious to get your bigger picture thoughts on that.
Yeah. So I think that the tech technology's impact potential is clear. So I don't think that's disputed, so to speak. So the more central questions that we ponder today that we're curious about is, well, hey, what's the return on this investment on $200 billion of capex being spent by a lot of hyperscalers and Meta? Or, I mean, implied data center AI, I saw Sequoia, I could say upwards of 300 billion. And then the second point is as investors, what are the embedded expectations in the current prices relative to the potential for returns? And so we come back to kind of, Amara's law, which is that we tend to overestimate the effects of new technology in the short term, but perhaps underestimate them in the long run. And we see some dangers of kind of this supply side wave today, this if they build it, they will come type of mentality, because a lot of the demand side today is mostly characterized as kind of experimental, or
Okay.
it's quite anecdotal, like Klarna comes up and some apocryphal story about cutting a bunch of customer service. Even BP Oil is talking about cutting 70% of third-party coders. But we don't see that in the demand generation in terms of real revenue generation for ultimately, which is where the rubber meets the road. And keep in mind that ChatGPT has been out for 20 months or more, 20 months. So it's not that new, so to speak.
So can I interrupt you for a second, just to make sure that I understand? So just back on Amara's law, are you suggesting that there's too much excitement at the moment, less with respect to the long-term implications of the technology, but just more how quickly individuals and companies can actually deploy them? Meaning, hey, we may think that this podcast could be done by AI in the future. I mean, we've got your likeness, your image, we've got mine. Certainly, we've been on the podcast enough times. There's enough samples of our voices. Could we just plug and play? So excitement around that potential, but just, hey, realistically, it's going to take a much longer time before we actually deploy that. Is that what you're saying in terms of just this delay in terms of timing?
Yeah, I think you're spot on, Rob. I don't know if we can replace you though, my friend. I mean, I think I think you'll be, out of the two of us, you're the hardest to replace. But look, I mean, you look at Accenture, right? Accenture has great visibility into companies and what they're doing, and they say only 5 to 10% of companies are even ready to use generative AI. So they have the data, the infrastructure ready to plug in these and be useful and productive to their environment. I read, something like Census Bureau is suggesting only 5% of businesses have even used AI in the past 2 weeks. And that kind of jives with that Accenture kind of idea. Now, a lot of consumers are using it. Apparently, something like 75% of global knowledge workers, where Microsoft and LinkedIn had a stat around that. But a lot of it is in a free capacity. I mean, I think about Prime Unlimited, like Amazon's Prime, 2-day shipping unlimited back in like 2005 when it first launched. It was $79 a year. So that's less than $7 a month. I mean, today I struggle to even sometimes fork out $15 for Netflix, and think of all the value it's produced for me, or the value I get out of it. And so I think it's just early days of seeing, and I think that there may be a mismatch between the timing of the investment, the scale and the magnitude of that, and the returns. And I think that mismatch can create opportunities down the line for us, where we're headed for some type of trough of disillusionment or something to that effect. And so the asymmetry today in our mind is still kind of, okay, there's a lot of uncertainty around this, but particularly with respect to what's embedded in prices of stocks. And it's the asymmetry as well, still identifying losers versus winners in a longer term perspective. Just one more stat for you here, Rob, is CEO of Microsoft, Satya Nadella, said we could justify the spend by getting GDP growth to double effectively from 1-2% to 3-4%. Now it's early days, but we don't see those productivity gains today, right? Economic data is actually showing it's slowing down, and so there is some mismatch between the scale and timing of the investment and the potential returns, I think.
Okay, and valuation being the great equalizer and all that. I want to talk about some other bigger picture themes or things that I've heard or read and questions that we've gotten from clients. that are more regional in nature. And so there's been a lot of excitement around corporate governance improvements in Japan. Well, just the US is a tremendous place to invest. And I know the global equity strategy has had long-standing underweights to both of those markets. And so, I suppose my question is about those two markets and how we're seeing opportunities there. But it's more just how process-wise we think about or incorporate some of these big picture themes, either with respect to idea generation or in terms of the portfolio construction.
Yeah. I think, first of all, I mean, we think that the lines are blurred, right? When we think of, particularly in a more global world. So to give you an example, we obviously own Publicis. It's French headquartered, but 70% of its profit roughly is in the US. And so that kind of is really, more of a US risk exposure type of company. Or, and from a sector perspective, we own Wolters Kluwer, which is listed as an industrial, but if I told you it provides data and software for professionals like accountants or lawyers, I'm not so sure we both characterize that as industrial. So
Right,
so
right.
some of these lines are blurred or some of them are distorted. But what we think of, we don't typically think of themes as chasing them. We think of mispricing for our time horizon and our investment process at a security level. And part of it is that chasing a theme is very difficult. And we often think about the billiard ball mental model, which is, one of the hardest shots is to hit a ball that hits a ball that hits a ball to go into the pocket.
Mm-hmm.
So you have to be right on the theme, then right on the securities that win in that theme, then not overpay relative to the expectations already priced into the theme to get the ball into the pocket, right? And so there's that's just not a 1 foot hurdle for us. And being right on the theme sometimes is not as easy as you think, particularly relative to the expectations priced into the theme. We also think about this mental model of the kind of narrative versus numbers. So we hear about the Japan narrative about improving capital allocation, and there's some inductive evidence of that in higher payouts. But we own a Japanese company, number two telecom operator in Japan, KDDI, and they acquired a convenience store. We've joked before in the past, I'm not sure I want to get my egg sandwich with my mobile data package, and KDDI has historically always had pretty high payouts, at least in the last 5 years, and so there is some narrative violation, so to speak. And so you can't go across the board and paint a broad picture. I think you have to get to the security level, which is where we look at it. And the last thing I'll say on that is we typically do capture themes in our assessment of skew, of how the distribution of outcomes can look. For example, Satya Nadella had said in 2020 that 5% of GDP is spent on technology. And that would double to 10% by the end of the decade. I mean, seems logical, right? And then obviously COVID has accelerated some of that. And if you have durable competitive advantages, a right to win with a good management team that won't squander that opportunity, then we would say, hey, that's positively skewed. And so we had owned Microsoft in part because of the positive skew and its exposure to that fast growing market and its ability to win in that market. And so we would consider those themes in that skew aspect.
Well, this feels like a weird question, given that markets are, pretty much at all-time highs. But what's got you most excited looking forward, either about the portfolio, the team, the market environment? What should clients feel really good about at the moment?
Yeah, I'm reminded of Warren Buffett. Once said you should sell all your IQ points above 120 because they're useless. Like you don't need IQ points above 120. I think the key is temperament, not intelligence, so to speak. And when I say temperament, I mean, you manage the highs and the lows. So you're asking me what has you encourage, we try to manage the highs and low, play the plan and follow our process and manage that with the inherent contradiction, which is we need to continuously improve and not be complacent.
Mm-hmm.
And so one thing that has me encouraged is our temperament is really, really good, Rob. So we're managing the highs and the lows on the team very well. The second thing that has me encouraged is the portfolio appears statistically advantaged. So if I use, I call dumb numbers, because we obviously do discounted cash flow and other methods. But on multiples, we have lower valuation or slightly lower valuation, higher returns on capital, better cash back from as a shareholder in terms of share buybacks and dividend yield if you combine the two. So that's in kind of the statistics as a portfolio relative to that. But in the intangibles, I think is also important. We think we have a better alignment, and you can see that, as a proxy is, we have 2 times the insider ownership as the benchmark, and lower economic sensitivity from an intangible standpoint. So, and that's kind of portfolio reviews that we do, that you can't just kind of that a monkey can't just point at the portfolio and say, but we think our judgment is reasonable on those 2 aspects. The last thing is I'm encouraged by the rocks we're kind of turning over here. I think the concentration creates more opportunity underneath the hood, right? I mean, just -7 is 493 just in the S&P 500, but we're a global equity universe, right? So typically we're quite index agnostic, but underneath the hood, we're finding a lot of high quality companies that could be mispriced because, the concentration is sucking the air out of the room. And so that creates, we think, opportunity that sets us up for the next 5 or 10 years.
Very good. Well, Manar, hope listeners appreciate your perspective. Hope you have a great rest of your summer. And we're probably due to come back together sometime in the fall, I'm guessing.
Sounds good, Rob. It'd be my pleasure.